Welcome to more financial talk. I'm Ryan Moore, and with me today is co-host Tony Shore. How are you doing, Tony?
I am great. Great to be here, Ryan. I'm over in the corner because I want to give the spotlight today to our special guest, but I've had a great week. Ryan, how have you been?
Yeah, doing well. Just moving and shaking. I actually had a special morning. I was over at Channel 4 News this morning. I
Oh,
was
wow.
interviewed for a Today in Nashville piece that's going to be airing in about 20 minutes.
Nice.
So that was fun and exciting. And they're really getting me out there these days, Tony.
I love it. I think that's great. They're having you on as a financial specialist and talking to you. I know the media loves to have you on to give the folks out there a lot of financial advice and strategies to utilize. That's cool. Channel 4.
Yeah, we've started a relationship with them back earlier in the year, and they're helping us in a lot of ways with some of our marketing and just
Sure.
branding and just trying to get the word out there.
That's great. Now, today's show is also special. This is a big day. We have a great special guest. I will let you announce our special guest and introduce him to the listeners.
Yeah, so with us today, we have Kyle Berbacker, and Kyle is a CFA portfolio manager for Gradient. He's a little bit newer to the team. He came on board with Gradient about 6 months ago, but we're going to get to know Kyle a little bit here today, and we're going to be talking rate cuts and bonds and all the exciting parts of the market, right? And I tease a little bit because I think many would rather be talking stocks and things that are more high flying. However, bonds are an important part to, people's portfolio. So we don't want to neglect those. But Kyle, happy to have you with us and great to have you join the podcast today. But love to hear a little bit more about your background and how you made your way to Gradient.
Yeah, great to be here. Thanks for having me. So I've been in financial services for over 18 years, something like that. So started originally before the financial crisis as an advisor, helping clients, built a pretty good sized book of business, and then realized I found a new path. I really like the data analytics, portfolio construction stuff. So transitioned my book to business partner and went to the buy side doing institutional money management for quite a few years now. I think 13, 14 years on the institutional side. So worked for Oppenheimer Funds, which is now Invesco, worked for Columbia Threadneedle, which is the money management arm of Ameriprise Financial, and then the Royal Bank of Canada as well.
Very nice.
Wow. RBC, that's great.
Yeah, so you like the technical side of things, which I can appreciate. I know this industry tends to bring out the nerdy side of me, so maybe we can relate on that. So, well, we're super excited to have you on today and to have you on the Gradient team. I know, everybody's spoken very highly of you. So, well, let's get into it. So, we're going to start talking rate cuts and bonds. So, let's start with the recent rate cut, which just happened a few weeks ago. That's was kind of a lot of talk, a lot of commentary going into that, very anticipated, and we finally got the rate cut. I think everybody was anxious for, but I think a big question on people's minds are, are we going to be getting more rate cuts, and what can we expect with the remainder of the year? Any thoughts on that?
Yeah, I mean, I think you're right on the money. All eyes were on that in terms of the focus, really all year long. I mean, people have been looking at unemployment. They've been looking at the economic growth. And the Fed finally came out and said, hey, we're going to go ahead and start the series of easing now that inflation is a little bit more under control. So if you look at the sell side kind of consensus from Goldman, from JP Morgan, those folks, it's really 2 to 3 rate cuts this year. We've already seen one. So we'll find out if we see another cut later this week, or excuse me, next week. And then from there, you'll skip November and then we'll look into December. So odds are pretty high that we'll see at least one, if not two, between now and year end. And then into next year, the data looks pretty compelling that we're going to see another probably 2 to 3. So they're definitely on the way to looser policy, and we'll see where it ends up in terms of the terminal rate. But we're in a new cutting cycle, that's for sure.
Great. Well, I know the real estate market will be happy with that. I know that's an area that's been long awaiting some easing in that regard to get the real estate market moving again. With such high mortgage rates, most people are not wanting to buy homes or even refinance right now. And so that can definitely help in that regard. So as we get to talking about bonds, I'm sorry, Tony, do you want to jump in on something there?
No, I'm actually good. I was just moving my
Okay, I got
microphone. No, I the Fed rate, yeah, my wife and I have been sitting on the sidelines waiting to see, because we're locked in at 2.9%
Ooh,
on our current mortgage. So
nice.
I'm not going to I'm not going to jump to 6 or 7 at this point, right?
Yeah, I would think not. So
Mhm.
yeah, let's talk bonds here a minute. Now, when I have this conversation with my clients and various people along the way, it seems to be for many kind of a complicated topic trying to understand the moving components as it relates to bonds. But let's just get, going with some basics here. So, as far as, well, let's just address what is a bond. So how would you define a bond, Kyle?
Yeah, so a bond is simply a debt obligation. It's a loan for traditionally, if you think about like a company or government, they all work the same. So it's effectively you're loaning money for a specified time, and there's interest based off the risk of that. So for a government, the interest is going to be generally lower if it's the U.S. government versus higher if it's an emerging market government, or a company, say for instance, Target versus General Motors, right? So time, risk, and you pay that back, which is different than equity ownership, where you actually own a stake of the company. You're not getting paid back a loan effectively.
Right. So typically they're loaning the money to raise capital
Hmm.
or to ultimately grow their business ventures, whatever that may look like.
Yep.
Now, when we're considering bonds, I mean, there's different types of bonds out there. There's different duration of bonds. There's different quality bonds. And just kind of, again, talking basics here, I think it's important to understand that quality of bonds are important, and there's a rating system for that, correct?
Yep. Yeah. So there's a couple rating agencies. You've got Fitch and Moody's are the main ones, and S&P, and they put ratings out there. There's a variety of criteria they look at, but yeah, they rate both sovereigns, so the countries, and companies as well.
Yeah, and I believe if investment grade is considered a high quality bond, which in many of these rating systems are the one that I follow would be AAA rated, and anything below AAA, which would be AA or below, would fall into a junk bond status, which makes for a greater potential chance of default. Because it may not be a higher quality bond. I think the trade-off there is junk bonds tend to give you a higher yield, the interest that you're going to earn on that because there's more risk to it. So, in order to entice investors, they're going to have to reward them for taking on more risk, correct?
Right. Yep. Yeah. So once you get into that triple B, bracket, you're taking on a lot more risk. You're in that junk status, and um, as you're taking more risk, you're hoping for more reward. So those are more equity-like in terms of the volatility, for sure.
Absolutely. So when we talk about bonds as it relates to interest rates, this is where I think it trips people up because ultimately it's an inverse relationship. And right when you hear that, it starts to boggle the mind a little bit. So typically what we say is, rates up, bonds down, and rates down, bonds up. So let's talk about that a little bit and ultimately how rate cuts affect bonds in the particular cycle that we're in. How is this going to impact people's bond portfolios? Ultimately, the bottom line for the client.
Yeah. So, to your point, it can be confusing for people. I think you set the table well on it. So if the Fed's cutting rates and rates are going down, then the bond prices are going to go up. And so depending on where you're at in the duration you mentioned earlier, how long that loan obligation is good for, you can kind of think about it like you're on one of those old diving boards at your neighbor's backyard swimming pool, right? If you've got a really short diving pool, so the duration's really low, like maybe a year or 2 or 3, there's not going to be a lot of wiggle room in terms of the price move of that relative to the Fed or whatever the rate is moving down. versus if you're on a really long diving board, it's going to have a lot more movement up and down in terms of the price. And so that same dynamic, that analogy works for the credit cycle. So you think if you're investing in long-term bonds and you've got a bond portfolio, if you're in the really short end stuff, the Fed moves aren't really going to have a huge impact for you in terms of what that cost of capital looks like for the companies or for the government debt that you're in. If you're on the longer term, so 20-year, 30-year bonds, for instance, as that rate continues to drop, if we do see 2, 3, 4, 5 rate cuts over the next, kind of 6 quarters or so, year and a half, those longer term bonds you can anticipate to go up much more rapidly. They'll appreciate. You'll see a bigger bang for your buck in that space.
Yeah, and I think what I'm hearing there is interest rate risk. And ultimately, the longer maturity of that bond, the greater interest rate risk, more movement to the bonds.
Right.
So as they cut rates, ultimately bonds provide a yield. That's the interest that they're going to pay for you taking on the bond. And that's, pretty straightforward. I think rates down, that yield is also going to come down. So bonds aren't going to produce the same amount of, yield, which for many is used for income.
Mm-hmm.
But I think the silver lining is that the principal value of the bond, the principal investment amount, can actually rise when rates are coming down. So, to put this in perspective, it was just a few years ago when we were having increasing rates, right? Which was one of the ways the Fed uses to try to manage inflation, to bring inflation down. And that presented, I think, a lot of interest rate risk to folks where, interest rates were going up. And when many view bonds as a safe location to park their money, they were really taking a big hit as rates were going up. The value of the bonds were going down. And I believe in 2022, the aggregate bond index was down altogether, right around 15, 16%.
Mm-hmm.
So a lot of times when people are trying to reduce risk and they're moving from equities to bonds, sometimes in the right or / wrong environment, you can really be going from the frying pan to the fire. So we have to be mindful of these things. One of the things that we want to also be mindful of is, where are we building a portfolio or a plan to actually draw income from? And, this is, to me, basic stuff, but, we all know that there's a lack of education out there. No fault to most. It's just not, our society doesn't teach a lot of this stuff to the everyday people. You either have to be in the field or seek out, finance classes in college, et cetera, that type of thing. So one of the common mistakes when people want to take income from their portfolio is they may start drawing from stocks or draw from mutual funds that have a mix of stocks and bonds in them. So when you have something that's fluctuating more like equities, it's not a great idea to be pulling from those on a consistent basis, because inevitably at some point we're going to get a downturn in the market, and then you're taking the withdrawal at the time the market's going down. And the way I phrase it, it's like taking 2 withdrawals, but you only get to keep 1, right? So right away, we want to make sure that as we're building an income plan for folks, that we're largely going to use bonds for a big piece of where we want to extract that income to help people maintain their standard of living and to ultimately get them the income that they need. So when I describe the difference between stocks and bonds, I'll kind of use this analogy. I think of it like this. Stocks are like the tires on a car, right? And you're driving down the road and that road gets really bumpy. Okay, those tires are going to go up and down, right? And that's like a volatile stock market, where I would view bonds as like the shocks on the tire. That's where the bonds are there to try to smooth out the ride and ultimately take away some risk and, make it a more stabilized situation based on one's risk profile. So ultimately, we want to make sure that if we're going to take income from market money, we typically want to take it from a more stable position, and that's where bonds would come in. So let me ask you this. Why are rate cuts good for stocks?
Yeah, so there's a couple things going on, but I think most simply put, it really is a function of setting the equity risk premium. So it's a fancy term for how companies are actually priced, what what differential there is between the tires and the shocks. So is it more risky to be in equities at a certain point or is it more risky to be in bonds? So to your point, you've already mentioned there's interest rate risk, there's credit risk, there's a variety of different risks for different instruments. And so as the Fed lowers rates, usually in the equity markets, what you'll see are more cyclicals, more value-oriented names working. So to your point, thinking about income, there are the blue chip stocks out there that do pay dividend yields, and some people, use those for a source of income. But in a down market, those you don't want to be double dipping on those things. You want to be able to reinvest those things to let your equity exposure grow and compound over time. That has a very different function than what we're talking about today, and that is using bonds for more stable allocation of income.
Right. And I believe that some people do view bonds as a real safe vehicle. And again, it's all about the market conditions and specifically interest rates as we've been talking about. But when you hold an individual bond versus holding bonds inside a mutual fund, maybe you can talk about the difference there and how there may be the illusion of protection with bonds, because there is a big difference whether you own it outright or whether it's wrapped into mutual funds.
Yeah, so there's a couple things that go on there. So one, you're buying a basket of a variety of different issues. So the individual bonds themselves are from an issuer, like a company or the government or whatever, municipality, that kind of thing. So if you're buying it in a mutual fund or an ETF, you're buying a basket of those things. And typically as an owner, if you go to Schwab or, Fidelity or whatever brokerage platform you're trading on, people will just buy those things blindly and not really know what's in them. And so what that creates is a couple risks. Is they don't know what they're holding. So the quality, the duration, what yield, what happens when the Fed moves around, that kind of gets the car sideways effectively, versus individually. If you're buying individual bonds, there's risks with that too. There's a deeper amount of research that needs to be done. And that's where, people like us on the portfolio management team that are, picking individual stocks or bonds, typically have that bandwidth, that capability, that research depth, and the tools to be able to dig into those things to say, this particular credit we want to own it for XYZ reason. And so understanding the difference between the two is pretty critical.
Yeah, and I'll just add to that, because it's my understanding, if you own an individual bond, okay, and let's say the value of the bond goes down because interest rates go up, you can hold the bond to maturity and you're basically made whole.
Yep.
You get your principal back, plus you keep all the coupon interest that it's paying you, right? So that's good to know. Ultimately, though, if you're holding bonds inside a mutual fund, mutual funds don't have maturity dates, and therefore you don't have the ability to hold a bond to maturity to get made whole if it's baked into mutual fund investments.
Right.
So I think that's important to know as well. I want to just go back to the whole, inverse relationship, because I want to add to that real quick. And one of the ways that I teach and educate on how to better understand that and what happened a couple of years ago, and why when interest rates went up, bond values came down, and how that impacts people. The way that I would explain it is this: let's say that you held a bond that was paying 3%. Okay. And that's the prevailing rate in the marketplace for bonds at the time. And then they raise rates. And let's say they raise rates by 2 percentage points, which we saw more than that a few years ago. So now there's bonds in the marketplace that are being offered at 5%. So if I'm a bond buyer, right, and I'm in the market to buy a bond, would I rather buy somebody's 3% bond, okay, that they're trying to sell, or would I rather buy a new bond at 5%? Well, I'm like everybody else. I want more interest. So if I'm going to go buy the 5% bond, then right away we all know that makes that 3% bond less valuable. And therefore they're going to have to take a discount and basically lower the value of it to be able to sell that bond. So that's one of the ways I try to explain, the whole inverse relationship and the complexities around understanding how bonds move. So,
yep, right on the money.
Yeah, great. So, proper planning for income, I think, is very crucial. We talked about that, making sure we're not pulling money from the wrong places. So we don't want to be haphazard about it. But the other thing to consider is that bonds are really just not producing or carrying their weight like they used to. I mean, if you look at where rates peaked, which would have been in the 80s, I mean, the yield and the interest on bonds have come down dramatically over several decades. And we got a nice little uptick here in rates with, what we experienced in the last few years. But here we are with rates about to go back down again. So, relying on bonds the way that we once did in the past, I would say things have changed. Do you want to maybe speak to that a little bit?
Yeah, I think, we're kind of in this new normal, and I feel like the 80s were definitely a different time when you could see high teens in terms of bond yields. That doesn't really exist anymore. And I don't necessarily think it will. I mean, if you think about the prevailing rates today, we were in like a zero interest rate policy for 15 years almost. And that has real, repercussions on how people generate income. So for years, your money market was generating zero, and bond yields were generating very, very low values. And so people were kind of forced into the equity markets, those blue chip stocks, really hunting for yield and dividend players. I feel like in the last few years, you've been able, despite the slight uptick in the Fed funds rate, you definitely have been able to generate yields in money markets now. You can get 3.25 or 3.75 to kind of 4.5%, which is better than it's been in 20 years. But now when the Fed's lowering rates, we're kind of looking back to what it was a couple years ago when rates were zero. So I think investors have to be aware of that compression, and the question they should be asking people like you is, where do you go? What do you, how do you manage that?
Yeah, so let me touch on that. Great segue. So first and foremost, when we start to work with somebody and they become a new client, we have them do a risk analysis survey. And ultimately, we need to get a profile as to what is their comfort level as it relates to risk in the market and otherwise. So ultimately, and we've talked about this in past shows, Tony, where our risk survey analysis is 11 multiple choice questions. And ultimately, what it does is generate a score, and the score is on a scale of 1 to 100, 1 being the most conservative, 100 being the most aggressive. So if somebody comes in with a score of a 60, that's going to indicate that 60% of their investable assets should be allocated to growth, and therefore the other 40% should be allocated to safer assets. So that would lend to sort of a 60-40 model. Now, my opinion is, so let's say we've got somebody that's got $1 million portfolio, right? Or even a $2 million portfolio. Well, under that, risk score, that would assume that, 40% of $1 million's 400,000, or 40% of 2 million is going to be 800,000. Now, in my opinion, and how we build portfolios, we're not going to just allocate the entire safer asset portion to bonds, because I don't think they're pulling their weight like they used to. And we just talked about earlier where it doesn't always give you the safety that I think you're looking for. So that's where we want to offload some of the concentration into bonds and look at other tools that are, within our resources. But many firms don't use these tools because they may not allow their advisors to offer them. And I'm specifically talking about income annuities. So that's where we would offload some of the bond concentration into an income annuity that is going to provide guaranteed income and other benefits that come along with it. So we're not overly concentrated in one area. And with the right type of an annuity, it is principal protected and provides a lot of safety and true safety. So that's why I think it's important to make sure that we're, identifying the right profile and building a plan that is not going to be overly concentrated in one area, and addressing the fact that bonds are just not simply, pulling their weight like they used to. So I just wanted to get that point in there.
I think you make a great point, and I think Kyle and Ryan, it was a wake-up call in 2022, at least for me, that hey, when bonds were way down and the stock market went down together, that 60-40 rule, it was kind of a wake-up call for people who still thought that was the really the norm, 60-40. And
Yeah.
I think you've made a great point throughout the show, both Kyle and you just now, Ryan, that the old 60-40 rule really doesn't apply because these are completely different times, right?
Yeah, they are. And, the 60-40 rule, I call those cookie cutter plans, and they may be much of what's being offered out there, but I think that that's falling short of specialization and customization, which,
Yeah.
we pride ourselves on so much. And it's just, I think there's better opportunities for people if they just get out of the box that they're sort of forced to operate within. And I'm thankful as an independent advisor that we're not limited on the resources and the tools within the marketplace that we can make available to our clients to really get more legs out of their life savings, essentially, and give them more peace of mind.
Yeah, but you don't want to take bonds off the table completely either,
No.
because I think they do provide a really great tool and asset allocation for people in certain positions. Wouldn't you agree, Kyle?
Oh yeah, totally.
Yeah.
Yeah, I think they're a stabilizer. And so we want to have some bonds in the mix. We're not anti-bonds. We just don't want to overly concentrate in that area. And ultimately,
Sure.
when we do start an income stream for folks and we're taking money out of the market, as I've mentioned, we want to pull it from the bonds. Or if we have a bond allocation and a client needs a one-off distribution for whatever, buying a car, getting a new AC unit, whatever the case, again, we want to pull it from the more stable position, and that we would look to the bond allocation first for any one-off needs for distributions.
Excellent.
Mhm.
Well, hey, I think it's been a great show, but before we go, our listeners probably have more questions and our viewers. So, Ryan, how can our listeners and viewers get a hold of you if they have questions or want to get a financial plan in place or want to get a second opinion on where their assets are allocated? How much of a percentage is at risk with stocks or bonds?
Yeah, absolutely. So we can be reached directly at area code 615-467-6300, or you can email our office at info@rsgtn, and our website is rsgtn.com.
All right. Well, and special thanks to Kyle. Kyle, thanks for
Absolutely.
being here. Awesome. A lot of great information. You've had a lot of great experience in this area. I think you've been a great guest, Ryan. That's a great get for the show today.
Absolutely.
And that does it for today's episode of More Financial Talk with our host, Ryan Moore. All right.
And we're out.